Let me give you the median of 8 economists here tracking Q2. What they do is as the data comes in, they change and alter their forecast. We take the median of it. Didn't quite get to 4, but darn close. 3.9% is the tracking for the second quarter. The range of 3% to 4.9%. Q1 tracking Q2. So we average two together. We get a 3% economy. Not too shabby. Let's take a look at what we're calling the 4% club. Stephen Stanley, Amherst Pierpont, good economist, 4.9. Oxford economist Gregory Dacre over there, 4.9. Atlanta Fed, 4.8. Moody's, they put the survey together for us. They're at 4%. And then we got the not 4% club. But the interesting about that is
Atlanta was only at 4.8.
Only at 4%. No,
not once they see this.
But here's the not. What's interesting about the not 4% club is they're darn near 4% club, right? 3.7, 3.6. Barclays, B of A, Action Economics, Chris Rupke over at MUFG at 3%. So the retail sales number was pretty hot this morning. Some of it bounced back from a weaker first quarter. Some of it perhaps borrowed from the third quarter. But the bottom line is the GDP numbers are going well. And that matters a lot, I think, for your earnings because that's the size of the pie.
Do you think anyone from the Fed is thinking about this major stimulus we've had from the tax cut as possibly or partly transitory, and that when it wears off, we're left with the debt that it took to finance it, but not the conditions that we thought would be sustainable?
Josh, you were watching the press conference yesterday, and you heard my brilliant question, which was just about that, if I might say so myself.
Was that the one, where's the men's room, or was there another?
No, it was a different one from that. But that's really the story, which is that if you look at the long-run outlook for every single member of the Fed, they're between 1.8 and 2.1.
So they think this is a transitory thing.
They think it's temporary. Their forecast for this year is 2.8, dropping to 2.4, dropping to 2. They don't necessarily see a very adverse effect from the debt side.
And how often do they hit the mark on their economic forecasts?
Almost never.
But don't you know what I want to sell? I want to say about as well as everybody at this table.
Yeah. But you know what? I don't care if it's 1 quarter or 2 quarters or 1 quarter. I don't care, because eventually what that comes down to is profits being higher than expected in this quarter. And where does that translate through? I'm going to take a page from your hymn book, Josh. It translates through to more buybacks, less shares outstanding, and a rising stock market. That's good.
Yeah, but Jim, that's not what they hope. What the administration and what the Fed hopes is that this translates into massive capital spending, higher productivity, higher
sell
wages,
this as a
higher
buyback.
yield
And
growth.
that gets us back to tech, because one of the things we're seeing this time, which is very different from previous cycles, is that more and more of the CapEx is software, it's services, it's tech-related, it's R&D related versus widgets and plants and equipment in the traditional sense. And so you think about tech today, it's organic growth, it's Amazon's cloud, it's prime services, it's overseas revenue. But it's also that every company out there is saying, I need to upgrade my
The other thing is, why does it have to be either or? Why can't it be CapEx and buybacks?
It can be, but you've seen
so
lag
far it's
on the
not.
CapEx.
Yeah.
Well, of course.
You should.
I think the economic effects matter, and I think it matters for Josh's question. So we made this very big investment, right, when we did that through $1.5 trillion or maybe more in terms of total debt. We're raising up the debt level.
Right.
If we don't get the growth to go along with it, we're going to have the bill anyway, which is what Josh is worried about.
Yeah,
we do need to see that happen.
It has to work.
I don't know that we get the same economic effect from the buybacks as we would from CapEx.
Let me ask you
it's positive to do
Let me ask you a follow-on, though.
Hold on. I'm sorry. I'm not suggesting otherwise.
Right.
I'm just saying there is a plausible and credible scenario in which you get CapEx and buybacks in some form or fashion, whatever the split is.
Well,
it seems to be this binary thing. It's either one or the other.
Well, I think what's been mitigating against buybacks is that we've had an unstable political environment. Now Trump's ratings have gone up pretty substantially, so people are feeling more comfortable with it. They weren't sure if the tax bill was going to pass. They weren't sure about trade. And all those have become annoyances rather than factors at this point. So I think you will see CapEx go, because you got to pick up productivity, which has still not been there in any degree as you would expect at this point in the economic recovery.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.